Back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman's recognized.
Well, thank each of you for testifying today. Let me ask a very simple question. You know, we had a $209 billion bank in assets, have a total meltdown from March 8th through March 26th. 18 days, you had a bank basically, from all outward appearances, was strong to the taxpayer, to the investor. And over those 18 days, it was a meltdown. Now, the warning signs that have been mentioned at this hearing, like the 6 citations, like the absence of a chief risk officer for 8 months, like the deficient government and controls, the signals were there for a bank that was in trouble. When the chairman started it off, I didn't see a sense of urgency from any of y'all on things to do other than we contacted staff or we contacted the immediate supervisors. When I was a director on the bank, if one of these citations had been issued, somebody's head would roll. We'd be having a conference call. Give me some assurance that I'm wrong, or I guess give me some assurance what specific actions you would take if this is duplicated. Because you had $20 million lost in the insurance fund, which the calls I'm fielding in my office are from the smaller banks. And, you know, a lot of people denying the taxpayers are going to take the hit. The taxpayers are going to take the hit at the end of the day because they're the ones that make the profit for the banks to pay the fees to the FDIC. Give me some, what does it take to get y'all's attention and to put a sense of urgency to situations like this?
I think it's an incredibly urgent situation. Obviously, when we learned of the immediate distress of the firm, we stepped in and took decisive action to make sure every American's deposits are safe, and we put in place a liquidity measure to make sure that banks all across the country would have the liquidity they need in case any institution were...
You're talking about over the weekend? When you found out on a Thursday, you're talking about over the weekend you took these steps. I'm talking about, did you not get these warning signals ahead of time?
Sir, the bank supervisory staff certainly issued those warnings to the bank. The question we're looking at, the review, is why those were not escalated in a more rapid way. I agree with you. You know, we want banks to be paying attention to supervisors, and almost every bank in the country, as you just described, if you get a letter like this, you get a series of problems like this. They had many, many problems. I'm focusing on liquidity and management and interest rate risk. But they had many other problems, too. You have a bank like that not responding, that's a real problem.
In your role as regulators, what would you do differently for each of you?
I think I'd start with making sure that we escalate things faster and intervene more promptly with respect to mitigation. But as I said, we've just started this review. I'm going to get a staff review back, and I want to really hear their expert judgment without any preconception about what they're going to come up with.
Did they jump to conclusions on having this as a systemic risk?
Pardon me?
Was it the right decision for the president to issue this, or I guess the board that voted on it, to issue this as or to deem this a systemic risk?
I think it was the correct judgment, sir. It was a very difficult judgment, I know, for everyone, but a unanimous Federal Reserve Board, unanimous board of the FDIC, and the Treasury Secretary agreed after consulting with the president. I think it was the right thing to do for the country. I think it saved a lot of small businesses and households, community banks, regional banks, from a kind of contagion that really could have been quite destabilizing. And we're now in a situation where I can say the banking system is sound and resilient. I think that was really the right thing to do.
Well, I sure hope so. What this has done is rattle the markets. was in the commercial real estate business, and banks that are loaning to commercial ventures are shook right now, particularly on the concentrations of credit on where they put their money, and particularly for that family that's put their life savings in an account that they thought was insured. What about what's your opinion on raising I get asked questions, the $250,000 insured limit?
Yeah, let me respond, if I may, Congressman. Seems to me that the decision to guarantee the deposits of these two institutions really raises that question up. As I indicated in my testimony, the FDIC is going to undertake a comprehensive review of our deposit insurance system. Certainly one of the things we'll look at and identify different options for consideration is the scope of coverage and whether we should increased coverage overall or for
Well,
particular
I would like to
types of
see, I'm
accounts?
running out of time, I'd like to see those reports, if you could furnish that,
Wait.
as well as if a rerun of what happened to these two banks happens again, what decisive role y'all would take that you may have not taken earlier. I yield back.
And the report will be out by May, Congressman, the report will be out by May 1.
The gentleman yields. The gentlewoman from Massachusetts, Ms. Presley, is recognized.
Thank you, Chair McHenry, Ranking Member Waters, and all of our witnesses for joining us for this critical hearing. I know it's been a long morning, but that being said, I truly hope that this is the first and not the last hearing that we're going to have on these recent bank failures. Now, when SVB collapsed, my office received urgent phone calls, texts, and letters from throughout our district from our constituents who were genuinely shocked and afraid for their future. Affordable housing residents unsure about the status of mortgages, tech companies not able to pay their employees, small businesses worried that they had lost most of their money. Now, while I'm glad we did avoid the worst possible scenario, Congress should consider SVB collapse a wake-up call and take action. After the 2008 financial crisis, Congress stepped up to enact Dodd-Frank, a comprehensive package of regulations in order to prevent bank failures and systemic risks that hurt the economy. However, in 2018, the Republican majority in Congress passed a deregulation bill that stripped away crucial requirements and got rid of enhanced prudential standards. Donald Trump and Republicans, including some of my colleagues sitting in this very room, celebrated signing this dangerous piece of legislation. The 2018 deregulation law specifically made it easy for SVB and Signature Bank to engage in risky management practices with little to no oversight, and we must rightfully assign some of the responsibility for this bank turmoil to deregulation efforts. Vice Chair Barr, when Congress passed the deregulation bill in 2018, which was lobbied for by banks like SVB, is it fair to say that it reduced supervision requirements by the Fed for small and medium-sized banks?
The overall effect of the law was for the smallest banks to reduce regulatory burden, for banks within 50 to 100 billion in range to limit the Federal Reserve's discretion with respect to those institutions. But for institutions over 100 billion, the Federal Reserve retained discretion to do something different. It chose in 2019 to put in place a set of rules that I think had the effect overall of reducing supervision and regulation of such firms.
Right, so it definitely did. The deregulation bill relaxed requirements for stress tests and resolution plans. The dangerous and irresponsible nature of this deregulation bill was completely predictable. In no way was this turmoil inevitable. The then Federal Reserve Governor Brainard opposed it, as well as both of you, Vice Chair Barr and Chair Gruenberg. And yet here we are. In the aftermath of the collapse of SVB and Signature Bank, it's clear that the Republican deregulation bill shares the blame alongside Treasury, the Federal Reserve, and the FDIC due to the lapses in supervision and oversight. Chairman Gruenberg, for folks who are concerned about the future of small and medium-sized banks in this country, what assurances can you give them?
Well, Congresswoman, as a general matter, our small and medium-sized banks remain in good condition, including their liquidity. And I think the actions we took did help to stabilize the system. And I think, as I indicated, any expense by the Deposit Insurance Fund to cover uninsured depositors will be imposed through a special assessment on the industry, and we have discretion to tailor that assessment to the institutions that most directly benefited. So we're going to try to be thoughtful in this process.
Thank you. And I'm requesting that each of your agencies provide my office and this committee by May 1st a list of recommended regulations that need to be enacted to strengthen the banking industry and to prevent future failures. The story of SVB's collapse is the story of a Republican administration in cahoots with the banking industry to weaken our financial regulations, but it is also a story of regulators' failure to do their #1 job, regulate banks. And since I'm accused of this often, I think I will close with a wokeism. The American public are tired of the super wealthy pocketing bonuses and leaving working class folks hiding the bag for their fiscal mismanagement. They're even more tired of Congress allowing them to do it. It is time to regulate. Thank you, and I yield.
The gentlewoman yields back. The gentleman from Ohio, Mr. Davidson, is recognized.
Thank the chairman. Thank our witnesses. Appreciate your endurance here today and yesterday. And as I listened to my colleague ask questions, I know my constituents are tired of seeing Washington, D.C., Congress in particular, socialize risk and watch profits be privatized. But they're also tired of people that don't listen. So I think one of the things that, Mr. Barr, when I was listening to what you said yesterday and today, S2155 isn't the reason that these banks failed. These banks were over $100 billion in assets, and therefore it's just a red herring. Isn't that accurate?
What I would say is that the Federal Reserve's rules issued in the wake of 2019, in the wake of the legislation that were issued in 2019, they did have the effect of lowering supervisory and regulatory standards for firms, but the Federal Reserve retains the discretion to have different rules. And one of the things that I think would be my job going forward is to put in place rules that are appropriate for that size institution. We have the discretion to do that.
Yeah, thank you. And so obviously it wasn't the regulation per se that failed, it was the regulator that failed. And I want to understand the context in which that occurred. So over the past year and a half, we've seen a substantial increase in the federal funds rate. And during that span, are you aware if the Fed or other prudential regulators had conversations not specific to Silicon Valley Bank about the inevitable interest rate risk that presents?
Yes, that is a core topic in supervision. Supervisors were very focused on interest rate risk. It was an important part of what we highlighted in our fall supervision report. Examiners were given beginning last year, extra training on interest rate risk. So it is just a bread and butter supervisory issue. It's not some esoteric problem.
So in that sense, did Silicon Valley Bank's failure surprise you?
Its failure did surprise me. Its risk-taking was excessive, but even then, I did not anticipate, I don't think anybody anticipated that they'd have a devastating bank run that basically wiped out, $42 billion on Thursday afternoon, another $100 billion expected the next day. That would be 85% of its deposit base in a 24-hour period. That was shocking.
Yeah, so we're anxious to understand all the factors that drove that run on that particular bank. But we're also curious when you stated yesterday to Senator Kennedy that stress testing does not examine institutional risks precipitating from interest rate risk. And when we were on the conference call with Treasury, with Fed, with FDIC, with House and Senate Republicans and Democrats, I asked the question, and there's some complex model that the stress test involves, and said, well, if macroeconomic conditions and whatever kick in, well, I submit that the hold to maturity spread has to be considered, not just the available for sale risk because of the need for liquidity. Is that something that you're focused on as you conduct your review?
Yes, I think you're absolutely right that we need to look at both sides of the balance sheet. We need to look at the liability structure and the asset structure. And the whole point is to assess whether under certain conditions you can have more stress on the liability side that forces you to sell on the asset side. Those are interrelated.
Mr. Gruenberg, do you share that concern about how we're looking at systemic risk?
Yes, I do, Congressman.
I would love to go into everything that I could on this, but Mr. Barr, on March 9th, you gave a speech that touched on stablecoins and brought up specific risks associated with stablecoins. In that speech, you stated, quote, this mismatch in value and liquidity is the recipe for a classic bank run. Stablecoin issuers are not supervised by the Fed and lack capital and liquidity as a backstop. The banks we regulate, in contrast, are well protected from bank runs through a robust array of supervisory requirements. Would you revise those comments if you could?
Yes, I think that, it demonstrates the need for humility in thinking about how financial risk happens in the system. That's been a theme of basically all of my academic work on systemic risk is we need humility, and that's why you need really strict capital and liquidity rules because of exactly the kind of circumstance we just saw.
Yeah, thank you for that. And, note, obviously, stablecoins are backed by assets and are properly regulated in many states, including the state of New York. Last thing I'd say is we have this pressure to socialize more of the market. There are credit unions that are completely privately insured, many in my district and in others, and I think we should look to that market for private credit risk insurance. I yield.
The gentleman yields. The gentlewoman from Michigan, Ms. Tlaib, is now recognized.
Thank you so much, and thank you all for being here. Vice Chair Barr, Silicon Valley Bank, which I feel like no one's focusing more on them as the bad actor here, in the mismanagement and the inappropriate actions. You kept saying over and over again that they weren't responding. If you had, we should have done something when we knew they weren't responding. I mean, what could have been done?
It's an excellent point. I mean, I agree with you. You start with the basic problem that the bank managers mismanaged the bank.
Did they hide something from us? What did they hid all this from us? Do you believe they hid this intentionally from the feds?
I don't have access yet to the full supervisory record.
Will
to
you
be able
let
to
us know?
answer
Because
your
I really
question.
do think they misled and probably lied and made some inappropriate and fraudulent probably actions that I hope that we'll hold them accountable to.
We will definitely be looking into that, and we retain enforcement authority to go after people who at the bank who violated the law or who breached their fiduciary duty or who engaged in unsafe and unsound practices, and we will hold them accountable
Yeah, and
to
Chairman
the fullest
Kruger, let's
extent.
not negotiate with bad actors like that. We think this is the time to really hold them accountable, honestly. This is how we set a precedent. But going back to you, Vice Chair Barr, bonuses were paid out when? When was the last bonus paid out before they
As I said, I'm still getting access to the supervisory
We know it was a
record.
couple hours before, correct?
I've heard news reports about that, but I want to make
So you
sure
don't even
that I
know
get
when the
full-
bonuses were paid out? You don't have that information for this committee right now?
I do not have that information
Was
right
it the
now.
day of?
I would like to respond to you fully and accurately, and I want to be careful to do that properly. I've heard news reports about the timing, but I don't
How
have
come
the
the
full...
news knows, but we don't?
Pardon me?
How come the media and the news know, but we don't? How do you not know this before our financial service? Because this is important.
I agree with... I share your outrage about it. I just want to make sure we get to the facts.
Do you even know how much the bonuses were?
As I said, I think you're hitting at exactly the right issues. We're going to use our enforcement authority to the fullest extent possible.
Well, now, everyone's saying, oh, we're going to go ahead and introduce some clawback legislation to see. But, Chairman Grubek, I asked the Fed Chair Powell about this. Section 956, it's been, 12, 13 years? When are we going to have a rulemaking on that? This is about excessive pay. This is about, this is something that Congress already considered. So how come it's over a decade that we don't have anything rulemaking? In 2016, there was a proposal. It wasn't great, but it was a really great start. It would have been instrumental here.
No, I'm familiar with the rulemaking, Congresswoman. I was strongly supportive of it. We didn't complete it in time.
Why?
Well, I think there was a change of administrations, and that may have had something to do with it. Every reason to come back to it now and complete that rulemaking. And
If you had it today, what could you have done in this instance?
It would have
Because
given us-
I'm tired of us being asked to pass things when I
would
feel
have-
like we already did, but
It would
it's
have
over
given-
12 years that we don't actually have something again that we could have used as a tool.
It would have given us explicit clawback authority on compensation. As I pointed out earlier, we do have, in fact, a legal obligation, the FDIC, to investigate the board and management of failed institutions and hold them accountable for any misconduct that might have occurred.
Yeah, public advocates really believe this could have maybe prevented this.
And so we'll
Primarily because, as you guys know, that there's some inappropriate decisions made up so they can do the bonuses
and that's
and the payouts.
and that's what we're going
It
to.
is clear as day, and I don't know why my colleagues are not even talking about that.
as
They're
I've-
talking about you all not getting things that, well, they didn't respond. How come nobody's mad at the bank for not responding?
All I can tell you, We've initiated the investigations to get the facts, to take action in regard,
Chairman-
assuming the facts support the
Chairman Grunberg,
allegation.
please, for the American people, we need a rulemaking decision on Section 956. You know how critically important this is.
Understood.
This is what I think it was, I read somewhere, this is the 563rd bank to fail since 2001. There are going to be more. And I know you guys don't want to talk about it, but there will be, because they'll mislead us, they'll lie, they'll do anything for the payouts. I mean, even the risk, what's that risk manager person? What did she give herself? What was it? This is a crazy amount of money she walked out with. I mean, it's crazy. And then Gary Becker, the CEO, sold February 27th, $3 million worth of stock, netting $2.2 million. And he knew this was going to be where we land. And we're not angry about that. We're angry because you guys didn't notice. Well, what about the fact they don't respond? They don't respond to inquiries and things. I
The
mean, that to
gentlewoman's
me
time has
is-
expired.